Hello, in this video we'll discuss Rule 501 of the AICPA Code of Professional Conduct, Discreditable Acts. This rule highlights that professional accountants not only have responsibility to the public, but also to the profession, and that certain things that accountants might do could bring harm to the profession. Discreditable acts, if left unchecked, can chip away at the very foundation of the profession's integrity. They can create an atmosphere of skepticism and distrust, not only among stakeholders, but also within the broader business community. The accounting profession relies heavily on its reputation for accuracy, transparency, and adherence to ethical norms. Discreditable acts can tarnish this reputation, potentially leading to a loss of credibility in financial reporting and related services. Addressing discreditable acts through Rule 501 involves cultivating a culture of transparency, accountability, and aims to preserve trust and ethics in the accounting profession. In short, Rule 501 intends to uphold credibility, ethical standards, and public confidence. Rule 501 lists 10 discreditable acts that can tarnish the image of the accounting profession and erode public confidence. They are misrepresentation, dishonesty, negligence, failure to follow professional standards, conflict of interest, failure to cooperate with investigations, discriminatory or harassment behavior, violation of confidentiality, failure to disclose material information, and substance abuse. So let's look at each one of these discreditable acts. Misrepresentation includes providing false information, engaging in misleading practices, or making unsubstantiated claims which can damage the profession's credibility. For example, imagine a certified public accountant, CPA, working for a company responsible for preparing its financial statements. The CPA is under pressure from the company's management to present a more favorable financial picture to shareholders and investors. To meet these expectations, the CPA engages in misrepresentation, intentionally manipulating the financial data to make the company's financial health appear stronger than it is. The CPA deliberately alters key financial figures such as revenue, expenses, and profits, creating a false impression of the company's financial performance. Misrepresentation violates the principles of integrity and accuracy that are fundamental to the accounting profession. The CPA's actions not only compromise their own professional ethics, but also undermine the credibility of the financial reporting. Dishonesty is engaging in fraudulent activities, deceptive practices, or unethical behaviors such as theft or embezzlement, and is considered discreditable. Honesty and integrity are foundational principles in the accounting profession. Consider a situation where a certified public accountant is employed at a mid-sized company. The company is facing financial difficulties, and its management instructs the CPA to hide certain financial irregularities from auditors and regulators in order to avoid negative attention and potential penalties. The CPA is directed to omit crucial financial transactions from the company's records, effectively concealing the true financial health of the organization. Dishonesty is a direct violation of the principle of integrity, which requires CPAs to be straightforward and truthful in their professional dealings. The CPA's participation in concealing information undermines the profession's commitment to accuracy and transparency. Negligence involves failing to exercise due professional care in performing accounting and auditing tasks, which can lead to errors and misstatements in financial information, potentially harming the interests of stakeholders. Imagine a scenario where a certified public accountant is responsible for conducting an audit of a medium-sized manufacturing company. The CPA fails to adequately review and verify the company's inventory records, resulting in a failure to identify significant discrepancies between physical inventory and the recorded inventory in the financial statements. The CPA's failure to thoroughly review the company's inventory records and detect discrepancies between physical inventory and financial records constitutes an act of negligence. The next discreditable act is the failure to follow professional standards. Failure to follow professional standards includes ignoring or violating established accounting standards, laws, and regulations, which can undermine the reliability and consistency of financial reporting, eroding the profession's credibility. The discreditable act conflict of interest includes failing to disclose or appropriately manage conflicts of interest, which can compromise objectivity and independence, critical aspects of maintaining professional credibility. An example for the discreditable act of conflict of interest might be a situation where a CPA is assigned to audit a company where the CEO is a close personal friend of the CPA. Despite knowing the importance of maintaining independence and objectivity, the CPA fails to disclose the personal relationship to the relevant parties and proceeds to conduct the audit. The CPA's failure to disclose the personal relationship with the audited company and its decision to continue with the audit represents a failure to follow professional standards regarding independence and objectivity in auditing. Failure to cooperate with investigations is refusing to cooperate with regulatory bodies or failing to respond to inquiries during investigations, which can be seen as an attempt to conceal unethical behavior and negatively impact the profession's standing. An example of a failure to cooperate with an investigation might be when a CPA is employed by a financial institution that is being investigated by regulatory authorities for potential financial misconduct. The CPA possesses crucial information about certain transactions that might be relevant to the investigation. The CPA chooses not to provide the information the CPA possesses to the regulatory authorities conducting the investigation, despite being aware of its potential relevance. This constitutes a failure to cooperate with the investigation. Next, let's talk about discriminatory or harassment behavior. Engaging in discriminatory or harassing conduct based on factors such as race, gender, or religion is not only morally reprehensible, but also reflects poorly on the accounting profession. Discriminatory or harassing behavior can have severe emotional and professional consequences for victims, while also damaging the reputation of the accounting profession. Promoting a culture of respect, diversity, and inclusion is essential to preventing such acts and upholding ethical standards within the profession. Violation of confidentiality occurs when the CPA breaches client confidentiality or discloses sensitive information without proper authorization, which can undermine trust between CPAs and their clients. Violating client confidentiality can lead to severe consequences for both the client and the CPA involved. For instance, a CPA is entrusted with conducting an audit for a well-known technology company, and during the audit, the CPA discovers sensitive financial data that indicates the company's struggles with profitability and potential layoffs. The CPA, without proper authorization, shares the sensitive financial data and details about potential layoffs with a friend who works in the media. The information gets leaked, and news articles start circulating, causing panic among employees and shareholders. The unauthorized disclosures of sensitive financial information has far-reaching consequences. Employee morale is negatively affected, and shareholders experience uncertainty, potentially leading to a drop in the company's stock value. Failure to disclose material information includes omitting relevant information or not disclosing material facts in financial statements, which can in turn mislead stakeholders and damage the profession's credibility. Imagine a scenario where a CPA is responsible for preparing financial statements for a manufacturing company. The CPA becomes aware of a significant pending legal dispute that could potentially result in substantial financial liabilities for the company. However, the CPA intentionally omits this information from the financial statements. The CPA's decision to withhold information about the pending legal dispute, despite its potential financial impact, constitutes a failure to disclose material information. This omission distorts the financial statements and presents an inaccurate picture of the company's financial health. The failure to disclose material information violates the principle of honesty and integrity. Substance abuse includes engaging in substance abuse or addiction that impairs professional competence and can have detrimental effects on the quality of work and the profession's reputation. For example, a CPA is struggling with substance abuse. The CPA's addiction to alcohol or drugs begins to interfere with their professional responsibilities, affecting their decision-making, performance, and interactions with colleagues and clients. The CPA's substance abuse leads to impaired professional conduct. Their addiction affects their ability to perform tasks accurately, make informed decisions, and communicate effectively with clients and colleagues. Due to impaired judgment and decision-making, the CPA may make errors in financial statements, overlook critical details, and miss deadlines. This compromises the quality of their work and negatively impacts their clients and the reputation of their firm. Substance abuse results in a violation of multiple ethical principles, including integrity, due care, and professional competence. CPAs are expected to perform their duties with the highest level of competence and ethical conduct, which becomes compromised by substance abuse. In addition, driving drunk could result in a DUI conviction, which are reported to the State Board of Accounting. The board will evaluate the factors, but the DUI may result in the loss of the CPA license. To summarize, CPAs have ethical responsibilities that include the CPA's duty to uphold the profession's image and trust, and the AICPA Code emphasizes that discreditable acts harm both CPAs and stakeholder trust. CPAs should also adhere to the AICPA Code, stay updated on ethics and laws, and seek guidance during ethical dilemmas to maintain professional standards. Upholding values of honesty, integrity, objectivity, and transparency is crucial in preventing discreditable acts and protecting the accounting reputation. Maintaining high ethical conduct not only safeguards CPA's reputation, but also ensures clients, investors, and the public have faith in the accounting profession.